Okay, so you want to own a luxury watch pawn shop. I mean, it's the dream, right? You buy a couple of Rolexes, you sit in this gorgeous, high-end, air-conditioned boutique on a plush velvet stool, and you just lend cash to wealthy individuals who need a quick 100 grand before their wire clears. Then you just kick back and keep a nice, fat interest check for doing basically nothing. Honestly, it sounds like the easiest, highest-margin luxury business on the planet, doesn't it?
Well, unfortunately, that glamorous assumption is entirely shattered by the gritty reality. See, the illusion is that you're running a simple retail watch shop, but the reality? The truth is, this business actually operates as a high-yield shadow bank managing some serious risk. Behind that velvet rope and the bulletproof glass, operators aren't really in the retail business at all. You're in the risk management business. Literally, if you get the valuation of a single counterfeit $50,000 Patek Philippe wrong, or if you miscalculate a sudden market drop, boom, an entire month's profit margin is instantly wiped out. Just like that.
In this explainer, we're going to be covering a few key things. Number 1, the shadow bank illusion. Number 2, 3 tiers of lending. Number 3, the arithmetic of risk. Number 4, high barriers to entry. And finally, number 5, surviving the downside.
Let's jump right into section 1, the shadow bank illusion, and why asset-backed lending is absolutely booming right now. To understand why this industry is exploding in 2026, you've got to look at traditional banking. Traditional banks have completely abandoned high-net-worth individuals who just need instant liquidity. Because of that gap, top-tier pawn operations handling these high-end timepieces can generate net profit margins exceeding 35%. That's huge. That means they are actually outperforming corporate giants like Apple, Ferrari, or even the very luxury watch brands they're lending against. It's wild to think about. So you're probably wondering, who is actually driving all that massive profit? Well, the primary clients aren't desperate gamblers like you might see on TV. The real customer, the one driving 80% of the volume, is an asset-rich but cash-poor entrepreneur. Let's say a real estate developer needs 100 grand by 2 p.m. today to close a land deal or just to cover payroll. A commercial bank? They're going to demand tax returns and put them through 3 weeks of agonizing underwriting. But a luxury watch pawn shop? They only care about the asset on the wrist. They act like a highly efficient secondary bank account. They provide instant liquidity, skip all those annoying credit checks, completely bypass underwriting delays, and offer these vital asset-backed bridge loans.
All right, moving on to section 2, 3 tiers of lending and how we structure the pawn industry.
So there are basically 3 distinct segments of asset-backed watch lending out there. First, you have the traditional high street shop. You know the ones. They take very low risk, offering maybe 30 to 40% of wholesale value, which results in really small loans, usually under 3 grand. Then way over on the other side, you've got the online lenders. They operate at a massive scale with low interest rates, but they suffer from ridiculously high customer acquisition costs, and they lack that immediate face-to-face trust. But right there in the middle, that's the specialized luxury boutique. This is the model we're really focusing on today. These guys operate in affluent metro areas, offering loans anywhere from $10,000 to well over $100,000. Now, they do run on tighter margins, typically 2 to 4% interest a month, but the sheer volume creates massive, high-dollar denominated returns.
Now for section 3, the arithmetic of risk, decoding the unit economics. The pure arithmetic of a standard 90-day loan life cycle is, well, it's wonderfully simple. Step 1, the shop receives a $20,000 asset. Step 2, the operator lends out $12,000 in cash at a 3% monthly interest rate. Step 3, over the next 3 months, the shop collects $1,080 in interest. And finally, step 4, the borrower repays the principal, gets their watch back, and the shop pockets that interest as reliable, cold, hard profit. It's a beautifully clean mathematical cycle, right?
But that leads us to a really fascinating question. If defaults actually yield a higher profit, why wouldn't an operator want every single client to default? I mean, think about the math for a second. If the client just doesn't pay, the operator keeps that $20,000 watch, sells it into the wholesale trade network for, let's say, $18,000, and makes a massive $6,000 profit on their initial $12,000 cash outlay. I mean, $6 grand completely dwarfs that $1,080 in regular interest.
Well, the answer to that puzzle lies in a magic little metric called the capital turnover rate. Basically, this is the speed at which deployed loan capital is repaid and freed up to be lent out again. The whole goal is minimizing the time your cash is frozen in physical inventory. See, when a default happens, your cash is instantly locked up. The operator actually has to wait out statutory legal grace periods mandated by local pawn laws, which can often be 30 to 90 days, before they can even legally clear the title to sell the watch. While you're waiting, all that cash is frozen, completely undeployable, and you are entirely exposed to the risk of secondary market price drops.
So really, the true engine driving this industry isn't defaults, it's operating leverage. Let's break this down. Say your fixed monthly operating costs, things like rent, specialized insurance, and armed security, are $25,000. $1 million in deployed capital might yield $5,000 in net profit. But watch what happens if you double that deployed capital to $2 million. The gross interest jumps to $60,000. And because your fixed costs remain totally flat at $25,000, your net profit doesn't just double, it absolutely explodes from $5,000 to $35,000 a month. Every marginal dollar of interest you make above that fixed cost baseline just flows straight to your bottom line. It's incredible.
Which brings us to Section 4, high barriers to entry and navigating the minefield. So if the profits are this good, why doesn't every wealthy entrepreneur just jump right into this?
Well, because this space is an absolute regulatory minefield. Amateurs literally cannot just rent an office somewhere and start handing out stacks of cash. Operators need state or municipal pawnbroker licenses, which involve deep criminal background checks and intense financial audits. On top of that, they have to strictly comply with federal anti-money laundering and know your customer protocols. Oh, and every single timepiece has to be cross-checked against global stolen watch databases, like the Watch Register. And you know the absolute biggest trap? Local usury laws and cap rates. If you structure a loan agreement incorrectly trying to bypass these statutory interest caps, you're looking at civil lawsuits, total forfeiture of your capital, or even criminal prosecution.
And then there's the financial reality of just opening the doors, which is frankly staggering. Just the physical and operational startup expenses for a mid-sized boutique in 2026 run around $390,000. About $180,000 of that goes purely to build out in physical security. We're talking UL-rated modular vaults, bulletproof glass, and man-trap entry doors. Another massive chunk, $49,000, is strictly for diagnostics. You see, an operator can no longer authenticate modern superclones with a simple little jeweler's loop. No way. You need waterproof pressure chambers, timing machines, and expensive optical X-ray fluorescence spectrometers just to verify that the watch isn't a brilliant fake, packed with cloned microengravings.
But here's the absolute kicker. That $390,000, that's just to open an empty vault. For an operator to actually be viable in the luxury space, you need at least $1.5 million in dedicated liquid lending capital. So you add it all up, and that pushes the total startup requirement to nearly $1.89 million. The barrier to entry here is phenomenally high.
Finally, let's look at Section 5, surviving the downside and the catastrophic risks. Because yes, there are severe existential threats that can literally bankrupt a business overnight. The big three are catastrophic market corrections, sophisticated superclones, and stolen property seizures. Let's say an operator accidentally takes in an $80,000 stolen Richard Mille and logs it into the system. Well, law enforcement is going to come in and seize it as evidence. Your loan principal? Gone forever, and you're left trying to sue a criminal to get it back. Or what if a high-grade counterfeit manages to slip past your authentication process? Congratulations, your shop has effectively just traded thousands of dollars in cash for about $50 worth of steel.
But honestly, a sudden market shift is the true nightmare scenario. Now, mega operators like Watchbox or Boro, they have tens of millions in capital and direct bank lines of credit to absorb a drop. But a small independent operator, they face absolute ruin during a correction. The 2022 market correction is a perfect, stark, cautionary tale for this. Look at how it unfolded. We hit peak market prices, and then, out of nowhere, there was a sudden tech and crypto pullback. This caused secondary market prices for the holy trinity of watch brands, Rolex, Patek Philippe, and Audemars Piguet, to just plummet by over 30% in a mere 6 months. So imagine a shop lent $30,000 on a watch that used to be worth $45,000. Suddenly, the market value drops to $25,000. That borrower is now upside down. They have absolutely zero financial incentive to repay you. They'll just default, walk away, and leave the shop holding an asset that's worth less than the cash lent out. The result? Devastating, unrecoverable principal losses.
Yet, despite all of those terrifying risks we just talked about, the ultimate revenue reality check is still highly lucrative. A well-run independent luxury watch pawn boutique operating with $2 million in active deployed loan capital can achieve a net pre-tax profit of anywhere from $349,000 to $569,000 annually. It is a truly remarkable return on deployed capital, but it absolutely demands flawless, unyielding risk discipline. Which brings us right to the core philosophy of this entire industry. The golden rule is this: an operator is buying risk at a discount and selling liquidity at a premium. The most successful operators out there, they aren't really selling timepieces, and they certainly aren't buying gold. They are strictly, coldly managing financial risk. So it all comes down to one final, critical question for you. Do the ambitious entrepreneur have what it takes to survive in this micro business? I mean, it is one of the most lucrative, recession-proof financial models in the world, but it requires a super rare combination of private banking discipline, deep horological expertise, and cold-blooded risk assessment. If you master the math, that vault door essentially becomes your own personal printing press. But if you forget the math for even a single transaction, you're just an expensive collector, paying top dollar for somebody else's mistakes. So, are you ready to take the risk?